The Central Bank of Nigeria has announced a phased operational overhaul of the Nigerian fixed income market in a strategic move to deepen transparency and efficiency in Nigeria's financial ecosystem. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okeri. According to the statement signed by Oke Umeano, Acting Director of the Financial Markets Department at the CBN, the first phase of the reform will see the Apex Bank take full control of both the settlement process and trading platform for fixed income and income transactions starting from November this year. The initiative, which forms part of the broader financial market reforms, is designed to enhance regulatory oversight and strengthen the market's role in supporting monetary policy transmission and economic growth. This transition will enable the CBN to assume direct responsibility for management of the trading platforms and undo end-to-end settlement activities under the bank established settlement system for financial markets transactions. The CBN emphasized that the objective of this phase is to strengthen market integrity, streamline operations, and establish a unified regulatory framework that ensures end-to-end visibility and supervisory oversight of fixed income transactions. To ensure minimal disruption and a smooth transition, the implementation will be executed in stages with active collaboration from key stakeholders, including Financial Markets Dealer Association (FMDA). The CBN acknowledged FMDA's pivotal role in developing Nigerian financial markets and called for continued cooperation. Reaffirming its commitment to the market development, the CBN assures stakeholders that the changes will be implemented in a coordinated manner to avoid disruption and serve the best interest of market participants and broader financial system. Recall that last month, the CBN issued a sweeping directive to domestic systematical important bank, mandating early succession plan for their managing directors as well as the chief executive officer and the top executives. The move is aimed at strengthening corporate governance and minimizing disruption that could destabilize the financial system. In a circular signed by the Director of Financial Policy and Regulation Department at CBN, Dr. Rita CK, the Apex Bank instructed that all DSIBs must obtain regulatory approval for successor, ND and CEO not later than 6 months before the expiration of the incumbent tenure. Bank credits to Nigerian private sector fell to 75.83 trillion naira in August 2025, the lowest level recorded this year according to the Central Bank of Nigeria latest money and credit statistics. The figure represents a 0.4% decline from 76.14 trillion naira in June 2025, underscoring a steady slowdown in credit expansion. On a year-on-year basis, the August 2025 figures was 1.5% higher than the 74.73 trillion naira recorded in August 2024. Showing only a modest improvement compared with last year. Net domestic credit stood at 98.97 trillion naira in August 2025, lower than 99.86 trillion naira in June and well below the 105.88 trillion naira recorded in August 2024. Reflecting a broad contraction in credit across the economy, monthly trade shows that the private sector was relatively strong at the start of 2025 with 77.38 trillion naira in January. It slipped to 76.26 trillion naira in February and 75.98 trillion naira in March before climbing to 78.08 trillion naira in April, the year's peak. From May, The number weakened, credit fell to 77.83 trillion naira, dropped again to 76.14 trillion naira in June, and eventually slid to 75.83 trillion naira in August, marking a clear downward trajectory. Government borrowing has also been more subdued. Credit to government was 23.13 trillion naira in August 2025, slightly down from 23.73 trillion naira in June and significantly lower than 31.15 trillion naira recorded in August 2024, reflecting a sharp contraction in bank lending to the public sector. The decline in private sector credit mirrored tighter monetary condition. For most of the 2025, the CBN maintained the monetary policy rate at 27.5% to curb inflation and stabilize the naira. The high borrowing costs discouraged fresh lending, pushing companies and also to cut back on debt. In the first half of the year alone, private sector loans shrank by nearly 1.9 trillion naira, a trend linked to high interest rates and tight liquidity in the banking system. In September 2025, the Monetary Policy Committee implemented its first rate cuts since 2020, trimming the policy rate to 27%. The decision followed signs of easing inflation, which stood at 20.12% in August, and the need to stimulate growth. The committee also reduced the cash reserve ratio for commercial banks from 50 to 45%, while tightening rules on public sector deposits by raising their reserve ratio to 75%. The persistent contraction in credit raises concern about business funding at a time when inflation, foreign exchange pressure, and weaker consumer demand are already squeezing the economy. Nigeria's move is part of a wider continental trade. Central banks in Africa are beginning to ease monetary policy as inflation cools. Recently, Ghana slashed its policy rate by 350 basis points to 21.5%, while Kenya lowered its benchmark rate to 9.5% in mid-August. Nigeria NPR remains among the highest in Africa, reflecting sustained inflationary pressure. However, analysts see this slight easing as a shift in strategy from crisis containment to caution stimulus. While welcoming the rate cut, members of the organized private sector argue that the reduction remains marginal and insufficient to ease the credit squeeze on manufacturers and SMEs. The Nigerian Deposit Insurance Corporation has urged Nigerians to be more vigilant against fraudulent investment scheme and Ponzi operations, warning that only funds placed in licensed banks are protected by deposit insurance. The managing director of the NDIC, Tomsi Sunday, gave the assurance in Abuja during the corporation special day at the 20th Abuja International Trade Fair. Managing director, who was represented by the director of the Performance Management Department, Bimpe Sunday, explained that the corporation mandate is focused on protecting depositors and safeguarding financial stability. He noted that the NDIC had over the years expanded its protection to cover depositors across different banking institutions. Depositors in deposit money banks, mobile money operators, and non-interest banks are covered up to 5 million naira, while those in payment service bank, microfinance bank, and primary mortgage bank are protected up to 2 million naira. According to him, this coverage ensures that nearly all depositors are safeguarded. The NDIC boss also pointed to recent cases where the corporation had acted swiftly to protect depositors in failed banks. Sunday further urged participants at the trade fair to take advantage of the NDIC pavilion to learn more about deposit insurance and how to avoid fraudulent operators. Earlier, the president of the Abuja Chambers of Commerce and Industry, Emeka Obelogu, who was represented by the Director General of the Chamber, Agbaju Gideani, praised the NDIC for its role in safeguarding the financial system. Obelogu says the corporation intervention had helped strengthen stability and protect small businesses. He commended the NDIC for extending deposit insurance to cover not just deposit money bank but also microfinance bank, mortgage bank, non-interest bank, payment service bank and mobile money operators. According to him, the step has created a more enabling environment for entrepreneurs and SMEs to participate confidently in the economy. Nigeria fixed income market closed on Thursday, October 2, 2025, with Treasury bill yield easing marginal across maturities, while the federal government bond market ended mixed, reflecting tight liquidity condition in the money market. FMDQ data shows that benchmark Nigerian Treasury bill and open market operation notes slipped slightly, with average yields dropping by 2 basis points. The NTB maturing October 9, 2025 closed at 16.37%, that is minus 0.01%, while the December 4, 2025 paper ended 17.69%. Longer date NTBs such as the July 9, 2026 and September 3, 2026 issued closed at 18.34% and 18.49% respectively, both easing by 0.02 percentage points. Omo bills followed by the same path. The November 4, 2025 note fell sharply to 20.85%, that is minus 0.84%, the steepest drop of the session, while the January 6, 2026 paper settled at 20.76%. Bond showed mixed trading. Shorter date maturity advanced, with March 17, 2027 bonding rising to 16.73% and February 23, 2028 paper at 16.57%. However, mid-tenor bonds softened, led by the May 15, 2033 issued, which slipped to 16.05%. Further along the curve, the February 21, 2034 bond gained modestly at 16.33%, while the April 18, 2037 notes declined to 15.99%. Ultra-long bond, including the April 26, 2049 maturity, were unchanged at 15.84%. Money markets tight, but neighbor eases. Short-term funding pressure persisted, with the open repo steady at 24.50% and the overnight rate easing slightly to 24.88%. In contrast, the Nigerian Interbank offered rate fell across all maturities, with the overnight 1 million, 3 million and 6 million tenor down by 11 basis points, 16 basis points, 31 basis points and 38 basis points respectively. This was attributed to the improved liquidity from inflows. The Nigerian Interbank Treasury bill true yield curve also declined, driving the average benchmark yield down by 3 basis points to 17.90% as sustained investors demand buoyed the secondary market. Nigeria's Euro bond market sustained bullish moment on the back of strong foreign demand. Buying interest, especially in February 2030, February 2032 issues, pushed average yield down by 7 basis points to 7.88%, spanning the short, mid and long end of the curve. Alright, let's take a quick short break now. We'll be right back. Don't go away, stay with us. Welcome back. If you're just joining us, it's Business Point on Global Television, where we extract the Nigerian economy and the government's policies. Nigeria has emerged as a key crude supplier to the 30,000 barrel per day Dakar refinery in Senegal, even as the country celebrated its entry into League of Oil Production Nation last year. Senegal began pumping oil in mid-2024 from Sagma field, which produces around 100 barrels per day of medium sour crude. According to a report by the industry analyst Playa, the report stated that virtually all this production is exported to Europe, with Spain, Italy, and the Netherlands taking the bulk of cargoes. However, despite being an oil producer, Senegal cannot feed its lone refinery with its own crude. Industry data shows that 30 KBD Dakar refinery is configured to run on lighter, sweeter grades, making Sagmo heavier, more sulfurous crude unsuitable. Pella reports that in recent months, Nigeria has imported about 30 KBD to air in Dakar, underlining Nigeria's role as a lifeline for Senegal refining system. Our refineries are built to handle certain specification of crude. The Dakar plan was designed for light, low sulfur oil, which makes Nigerian grades like air an excellent match. It was learned that Sagamo crude would require blending before it could be processed locally. Still, Nigerian crude exports only meet part of the Senegal fuel demand. The country remains heavily reliant on refined product imports. Between 2024 and 2025, Senegal imported 90 to 100 KBD of fuel, with as much as 60% coming from Russia, mostly gasoline, gas oil, diesel, and fuel oil. To fully meet domestic product demand, Senegal relies heavily on refined imports, particularly from Russia, of 90 to 100 KBD to refined products imported during 2024-2025. 50 to 60% originated from Russia, mainly gas oil, fuel oil, and diesel. This indicates that while Senegal, an oil exporting country, relies on Nigeria for crude refinery feedstock, it also depends on Russia for finished fuel, with phase 2 of Sagma under review, involving 33 new wells and a tentative 2027 startup. Pella expected the country's crude output and the export to remain steady at 100 KBD for the next few years, leaving Nigeria air, crude, and Russian products as pillar of Senegal domestic energy balance. Meanwhile, local refineries have repeatedly complained about the low crude supply for their facility. The Dangote refinery said it was increasingly relying on crude from the United States to meet daily production. All right, before we call it a wrap, let's take a quick look at the stock market. Domestic investors on the Nigerian Exchange Limited reduced their trade by massive 932 billion naira in August, dragging down the overall value of transaction on local bourse. According to the Nigerian Exchange Domestic and Foreign Portfolio Investment Report for August 2025, total domestic participation fell by 55.87% from 1.669 trillion naira in July to 736.57 billion naira in August. The sharp decline was largely attributed to the absence of block trades, which had significantly boosted volumes in the previous month. The fall in domestic activities also weighed on the broader market. Overall transaction dropped by 49.95% month on month from 1.815 trillion naira in July to 908.38 billion naira in August. Despite the steep drop, Activities in August was still much stronger than the same period last year, compared with 379.52 billion naira in August 2024, and the August 2025 figure represents a 139.35% increase. A breakdown of the August report shows that institutional investors were the main driver of the slump. Their trade plunged by 65.91%, sliding from 1.152 trillion naira in July to 392.9 billion naira in August. Retail investors also pulled back, but less drastically, with transaction declining 33.46% from 516.5 billion naira in July to 343.67 billion naira in August. Institutional players still accounted for the majority of the market at 53%, compared with 47% for retail. In contrast, foreign investors stepped up activities as their transaction rose 17.72% from 145.95 billion naira in July to 171.81 billion naira in August. Inflow reached 95.14 billion naira, while outflows stood at 76.68 billion naira, indicating relatively balanced sentiment. As a result, foreign activities made up 18.91% to a total trade in August, up from 8.08% in July. Domestic investors still dominate with 81.09% of transactions between January and August 2025. Domestic investors trade 5.463 trillion naira, compared with 1.453 trillion naira by foreign investors, showing local accounted for 75% of activities in the first 8 months of the year. Both domestic and foreign participation also rose strongly year on year. Domestic transaction nearly doubled from 2.82 trillion naira in the same period of 2024, while the foreign trade more than doubled from 655.5 billion naira. The longer-term trend shows that domestic investors continue to provide the bulk of market liquidity over the past 18 years. Domestic transactions have risen 33.15% from 3.553 trillion naira in 2007. All right, this is where we call it a wrap on Business Points today. Join me again on Monday on Business Point on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms at Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.